I very much appreciate it. Thank you all for joining. I know, as I've said in the past, tax law is not the most fun thing to watch a seminar on, but I appreciate your time, and it certainly is a unique time for tax planning. So I'm going to go maybe 10 minutes, spend about 10 minutes talking about where we are now, what we believe we will actually see next year. So this is the sort of reconciliation package issues, all of those kind of things. And then the next 35, 40 minutes on some things to be considering coming in on year end. Not all of it will be something you have to take action on immediately. Some of it will, but we'll go through some of the things that everyone should at least be considering as we get towards year end. Okay, so let's start with where we are from a tax perspective. Now, keep in mind that typically the year-end tax planning piece is a relatively simple concept, right? We look at the laws as they exist, we know where they're going to be next year, and so we make some decisions about the things we should take advantage of at year-end. This is entirely unique in that we really don't know what next year is going to look like. We have a better view now than we did. I thought our view was better in the past, and I'll talk a little bit about that here in just a second. So let's go into where we are and where we thought we'd be. Okay, remember we have reconciliation because anytime you read an article about the tax changes and what's occurring, they have to spend a paragraph explaining the fact that Democrats have a slim majority in the Senate, and so they have to use the reconciliation process to get any tax changes through. This is the same thing that the Trump administration did with the Tax Cuts and Jobs Act. And although I thought this would happen much smoother than that did, if any of you were paying attention, we got the Tax Cuts and Jobs Act on December 22nd. And I thought, well, the good news this year is that we won't be dealing with that. We won't be dealing with Christmas Eve tax planning. That appears not to be the case. It looks like it's going to take a lot of time to get this done. We could go even further than that. So here's what we thought was going to happen, just so we understand sort of the context. If you watched any of the things that I put out before, I was almost certain that we were going to go back to the Obama era tax rates of 39.6%, because they're scheduled to go back there anyway. It seems like a simple maneuver, especially given some of the verbiage we were hearing out of the White House. We thought we were going to see an increase in capital gains. The White House took the position that the capital gains rate was almost a special tax rate, a special lower tax rate for rich people, and that it was it should be increased and maybe dismantled entirely. We thought these huge estate tax exemptions that I've talked about on a few occasions, is almost $12 million per person before an estate tax applies. We thought those were going to come back down again. They're scheduled to come down by 2026. I'll talk more about that. We thought those were coming down earlier. I was also worried that like-kind exchanges might go away. Many of our clients are real estate investors, understand in like-kind exchanges, that's the process where you can sell an investment piece of real estate, and so long as you take all those proceeds and invest them in a new investment piece of real estate, you defer all the capital gains on that. Thought we might be in trouble there. Also thought that some of the techniques that we use to help our clients, especially those clients who have real estate investments or closely held businesses that they want to keep within the family. There are techniques that we can use so that as those investments appreciate, as that business appreciates, we don't see a corresponding increase in their estate tax liability. So that we're trying to protect those assets that we're trying to keep within the family. We thought we were going to lose a lot of those techniques that we use frequently. I'll go into that a little bit more. And then finally, we thought there was a full frontal attack from the Biden administration on the step up in basis at death. That was positioned as the largest loophole in the tax code. That is the concept, of course, that if our client inherits a $5 million piece of property from her mother and her mother's basis was $1 million, our client's basis is $5 million because it's equal to the value at the date of death. Now, that means our client the next day can sell that property and pay nothing in capital gains tax, which means, of course, that $4 million of appreciation did, in fact, what was taken advantage of by the family as a whole, at least, without paying any capital gains. As I mentioned frequently on that rule came to be in existence. That rule is in existence because there's a concept that you're going to pay an estate tax and therefore you deserve to step up in basis. However, the distinction between the estate tax and then just obviously the general assets people receive at the death of family members has become, there's a huge breach there that the two no longer correlate. So we were sort of surprised. I was surprised that we we're going to keep that basis step up. So those things that I was almost certain about, those things that I was worried about, none of them made it into the latest stripped down version of the bill that we have. The latest stripped down version that we have is a proposed bill, just like the things that we were looking at before were proposed bill. We even saw legislative language, but it looks like those things aren't going to make it. And if this comes to pass, there are a number of bets I have outstanding that I am going to have to pay up on, because this is really not what I anticipate. As I give you clarity that even on a personal basis, I really believe strongly these changes were coming, and I thought I could profit from it. So what do we see? What is in the new bill? Well, there's lots of stuff that's in it with regard to child tax credit, things like that. I'm not going to get into that. What impacts our clients, or should we be thinking about? Those are a couple of things I'm going to talk about. And the largest one, the biggest issue really, or I guess the biggest change, is a couple of surtaxes that are being applied. We talked about this a little bit. There was a concept that we were going to create a surtax on capital gains. Now instead, there is simply a surtax on all income above $10 million. It's a 3% surtax above $10 million, and then a 8% surtax above $25 million. And as I read that, I realize that may be wrong. That might be a 5% surtax at 10 and an additional 3 at 25. So I apologize about that. It's a 5% surtax above $10 million and an additional 3% for a total of 8% above $25 million. I'll correct that before we post it. So the concept, of course, is, hey, look, those are only 0.02% of Americans are making that kind of money on a regular basis. And that's true. Those who have that kind of income regularly, that's pretty rarefied air, not the taxpayer that most people are concerned might have to pay a few more percentage points on an annual basis. But keep in mind, that's not really where the impact of this is going to be. It certainly will impact those people who make that kind of money, and they're out there. But it will have more impact on those clients of ours and Americans in general who have large liquidation events, right? It's a surtax for those people who choose at one point maybe to sell that real estate investment portfolio. Maybe they are going to sell that closely held business that they've built over years and years. Depending on the size of the sale, of course, we could be facing some pretty significant surtaxes in that scenario, which will mean, of course, that there's going to need to be some planning around that to the extent that's possible. There's one other change that we're looking at, which is actually an increase in the state and local tax deduction. We all probably remember that the Tax Cuts and Jobs Act took our unlimited SALT deduction and dropped it down to $10,000 a year minimum. That's your maximum that you can take advantage of. Well, certainly for those of us in California, you hit that very, very quickly with almost any income at all, plus property taxes, etc. That is the most recent proposal, is to increase that to $80,000. There's a lot of push from some Democratic members to get that back to its unlimited place in the past. However, I think there's a real issue, and you're going to hear more about this, in that the beneficiaries of increasing the SALT deduction, really at any level, are almost exclusively the higher end taxpayers within the country. The top 1 or 2% benefit from any increase on this. And those who really benefit from the $80,000 are really, again, in the top income taxpayers. And so there's a little bit of a hypocrisy. It's positioned for those who are not proponents of this bill, those who would rather see this die on the vine, would take the position that why are you adding a tax benefit for the wealthy when the entire position of this was you are only going to impact those, you're only going to increase taxes on those who make more than $400,000 a year. Not clear yet how that will resonate. I do suspect, though, we are going to see a SALT deduction within the bill because it has been so hard to get politically where we are now. We are really, the Democratic Party specifically, is really trying to thread the needle here. So I don't think there's a whole lot of room to move one way or the other. There are some things in the bill that Democratic senators have said that they won't support as is written. None of those are the things I'm talking about here. So I suspect we're going to see this. Nothing is true until it's signed by the president and law. I'm done prognosticating and telling you what I think is probably certainly going to happen. All I can tell you is this is the bill, and I find it hard to believe that after all the machinations that have occurred, there's really any room to make some additional movements. I want to cover a couple changes too that will have impact on our business owner clients. The first that will impact those clients for the most part who have S corporations. Many of our clients and many of you who own businesses have considered at least an S corporation. Talk to your CPA about it, because there's an employment tax game, if you will, that you can play with an S corporation. And what that means is there are employment taxes that apply to, salaries, etc. One of those is the 3.8% Medicare tax. When we got the ACH, which is, the sort of also known as Obamacare, there was an additional tax imposed as part of that, the net investment income tax, a 3.8% on investment income, because we had the Medicare tax that hit salaries and was an unlimited number. So we imposed an equivalent tax on those investment earnings for people who weren't paying the 3.8% on salaries because it was investment income. Well, the S corporation found a sweet spot in between where they could avoid both sides, because an S corporation owner, our client, the S corporation itself makes $1 million, so our client makes a pays herself a salary of $100,000. There's $900,000 left in the S corporation, so she makes a dividend distribution to herself of that $900,000. Only the $100,000, the salary has employment taxes, including Medicare tax. The distributions are not subject to that 3.8% Medicare tax. And because I'm actively involved, or my client is actively involved in the business, it's not net investment income tax either. So there is this little crevice that we've been playing that game in, and really seeing some pretty tremendous tax savings for a lot of clients. That looks like, as I've talked about in the past, that crevice looks like it's going to be paved over. And certainly what may have in fact been a loophole will be pretty summarily closed, unfortunately, as part of this process. Something that hits a lot of our clients more than you'd think, qualified small business stock exemption. This is also known as 1202 stock for any of you who have paid attention to this. A lot of our business owning clients are starting businesses or have started them and want to position themselves to take advantage of this exemption. I'm not going to get into the qualifications for this. You have to have founded the business, it has to be a certain kind of corporation, etc. But if you qualify, it can be $10 million of tax-free income upon sale of that business. And that $10 million can even be multiplied if we use the right number of strategies and we use them in the right way. Well, the new bill would bring that 100% exemption down to 50%, which is, by the way, where it was originally. It was increased to 75% and then 100% in an effort to really get people about a decade ago really investing in businesses again. But those, of course, who are benefiting from this are the top taxpayers. So that's falling back down to 50%, and we're losing some of the ways that we could take advantage of additional qualified small business stock. There's also a limit to the use of active pass-through business losses. To the extent you have those, you probably are aware of that. That's not new. That is in place this year, but we're going to continue that. So you can only take those losses forward. You can't carry them back. The only thing to keep an eye on with all of this is for business owners, that bill AB 150. I won't go into all the detail about that. We've got another video on the site if you want to watch that. But it does permit a lot of owners of those pass-through entities to elect to pay California their California income tax now, and therefore get an indirect deduction, even if the SALT deduction is not changed. So there's a real advantage for a lot of our clients. There are a lot of complexities as part of that. And for those of you who started to try to work with that in 2021, you realize we've got a tentative minimum tax issue in California and a couple other things. I think a lot of that's going to be resolved in 2022. So this can be a real advantage. but we just don't know what our federal SALT deductions are going to look like. We definitely want to keep an eye on AB 150. More about that later, but the another issue to consider there is that AB 150, that SALT deduction rule, has a self-destruct mechanism in it. The law itself says it will no longer apply, it will evaporate if the federal SALT deduction is lifted or eliminated, meaning do we get that unlimited SALT deduction back? Well, that's almost certainly not going to happen. We may get a greatly increased exemption, but we're not going to, it's not going to be eliminated. So are we going to have both? Are we going to get to use $80,000 of SALT deduction in other things and then get an indirect deduction from any California income tax we have to pay from our pass-through entity? That's possible. That could be a windfall for a lot of our clients. We'll have to see how that develops. Okay, so what should we be thinking about at year end? One caveat to all of this, first and foremost, is you've got to be talking to your tax advisor about this, right? Talk to your CPA, talk to your other tax professionals as you're working through these issues, because everything here has complexity that needs to be looked at on an individual basis. There are no straight laws that there are no straight rules that we can simply talk about and just say this applies to all of you, do it or don't. There's always complexities, and so you're going to have to work with your tax advisors. And of course, to the extent there's questions, you should feel free to give us a call as well. The other thing is, right now, I'm presuming in these in the steps that we might take at year end, I'm presuming that our taxes, that the tax rates next year, but for the things that we talked about, but for the surtax, the S corporation change, etc., all of these rates look like they're going to be the same. And so we can adhere to that sort of standard tax advice of defer income, accelerate deductions, because just the simply present value nature of not having to pay a bill until later, getting to reduce the bill I owe now makes the most sense. If in fact we do see capital gains rise, if in fact we see the ordinary income tax rate increase, some of this will be inverted, and it would be a difficult, and so that's just a disclosure I have to make, because I can't tell you when we're going to know for certain, and it could be very, very late in the year. Remember, December 22nd was when we got the last one of these. So take everything I'm saying here with a couple grains of salt. Number one, and that I don't know what was going to happen, and number two, I was as wrong as I could be in the past. So let's start from there. Okay, the standard income tax planning, right, is minimize your income wherever possible. Wait to sell anything that has gain inside of it. If you could sell it today, or you can sell it in January, let's think about waiting for January or February. For businesses that are cash method, defer those invoices if you can. Defer receiving that cash. Now, we talked to a lot of business owners about that, and understandably, that's concerning because clients already take 60 days, 90 days to actually pay that invoice. So it feels uncomfortable to delay the invoice. And I completely appreciate that. And as I will say always when looking at this stuff, don't let the investment or the don't let the tax tail wag the investment or the financial dog. We'll talk more about that later. Don't let any of this interfere with the business realities of what's going on. But to the extent you've got flexibility, here are some of the things to be thinking about. Minimize income, maximize deductions, right? There's no magic to that. Look at qualified plans. We're going to talk about that in a little bit, but maximize those contributions to qualified plans for which you get a deduction. Sell loser investments. If you've got stocks that have turned around on you, or other investments that you've got losses in, let's harvest those losses. We'll talk more about that in a second as well. Take advantage of the $3,000 capital loss against ordinary income. That, of course, will be sort of standard. Your CPA will help you with that if you qualify, or if that's the circumstance you're in. Incur those deductible business expenses now, right? Accelerate those deductible expenses, where we should wait to sell. Don't sell in December, sell in January, February. If you've got expenses you have to incur, don't incur those in January, February, incur those today. Put new equipment into service. That's Section 179 equipment. You get 100% deduction for that this year. Put that in service before year end if you can. And then from a charitable perspective, a charitable giving perspective, Let's think about bunching some of those together. I've got more about that in a little bit, but let's take the biggest deduction we can in a year with a lot of income. This advice sort of depends on what you expect your income to be this year and next year. So you do have to do some analysis. But again, from a present value perspective, deductions today are worth it, especially if it does not impact the way we want to give tomorrow, right? We want to take the deduction now and give in the future at the time of our choosing. We'll talk more about that. From the business specific issues to think about sort of towards year end, again, work with your advisor about your net operating losses. We talked a little bit about that, but you need to sort of, to the extent possible, let's time those losses, because now we can only go forward with them. We cannot go back. So let's make sure that if we're going to be in that situation, we're doing it at the right time and we're not going to lose any of those deductions over time. Although those can extend essentially forever, you still need to make sure that those deductions are corresponding with some income that you can use them against. Maximize 199A deductions. This, you may remember this came with the Tax Cuts and Jobs Act too. It's a 20% deduction on qualified business income. I definitely will not get into the detail of this because there are a lot of levers and pulleys and dials to turn to figure out how much of the deduction you get. But if you employ a lot of people, if you have a lot of real estate as part of an operating investment, you may very well have some benefits you can take from this. So let's make sure you're doing that. And then also, I mean, at the end of every year, and we'll talk more about this later too, you should be reviewing your documents. Review your business entity structure. As I said, the S corporation advantage that we talked about, right? An S corporation is a corporation, just like Apple is a corporation. It's got a special pass-through. There's a special pass-through that is permitted because you elected S corporation status. So there is an advantage. You get the advantage of not paying a double tax, but still having this corporate environment, which gives us that place to play around as far as the employment tax goes. Well, once that advantage is gone, there's actually not a whole lot of there's not a whole lot of advantage to an S corporation versus our other pass-through entities that are available to us, versus a limited partnership, an LLC that is essentially taxed as a partnership. There are a lot of advantages to that kind of pass-through entity that do not exist for an S corporation. And so we might, as we lose some of the advantages that an S corporation brings, and really, as I think about it, the only real big tax advantage an S corporation has over LLCs and limited partnerships. If we lose that, maybe we want to think about making a conversion. Typically not a huge issue. It's relatively simple from a state perspective and from a federal tax perspective. Those are things we're going to want to be thinking about. Also be paying attention to any opportunity, of course, to eliminate tax or to defer tax substantially. And there's a couple of those that exist. The first is a qualified opportunity zone. So you probably remember hearing a lot about this during the Tax Cuts and Jobs Act. There hasn't been much press around it recently. And when we talk to clients about this, you know, we say, look, there's this opportunity, no pun intended, to make investments in areas, especially if you're already a real estate investor or real estate developer, if those are the kind of things you're investing in, your commercial real estate. Think about these opportunity zones, and a client will very fairly say, look, I'm not interested in urban blight. That's not my business model. That's not the way that I operate. I will tell you that the opportunity zone, the swaths of territory that qualify for this are gigantic, and they are all over the place. It's very easy to Google qualified opportunity zone map, and then you can dive into a nationwide map of where all the opportunity zones are. The map itself is run by the federal government, so it's not as user-friendly as it could be, but you can dig down into any area you're looking at. For instance, here in San Diego, for those of our clients who are here, just as an example, there are a number of qualified opportunity zones within San Diego, but one is right at Petco Park. Anything south and anything east of Petco Park is a qualified opportunity zone. And if you think about and look at what has occurred downtown in the downtown area recently and over the past decade or so, there's really an amazing amount of area there that's being gentrified. There's incredible building happening there. That all qualifies and so is available to take any capital gains that you have, short-term, long-term, anything else, and you can put it inside of a qualified opportunity zone. First, you get to take your basis back, meaning you get to put your basis back in your pocket if you sell a capital gain asset. Then you just take your gain and invest it in a qualified opportunity zone. You pay 0 capital gains tax at the moment. And then it gets deferred over time. And then ultimately, some of it is eliminated and it's paid later. Lots of complexity there. If you have questions, we're happy to talk to you about it. And the other thing, I already mentioned this some, but it's a real surprise to a lot of clients that if they orient their business appropriately, they might qualify for 1202 stock exclusion, that $10 million exclusion. Now, it may only be 50%, but still, selling something for $10 million and only paying capital gains on 5 is a pretty good deal. So pay attention to that. If you think you might qualify, again, talk to your tax advisor, talk to us. There may need to be some reconfiguring. We've got a couple of clients actually that are working on that, started businesses as an LLC, starting to have some great success. So they're going to want to make some conversions, some business entity conversions to start a clock that begins for qualified small business stock so that they may be able to take a real advantage of that in the future. Okay. Did this not move, or did I just double up there? Okay. All right, here we are. Tax loss harvesting. We talked about this a little bit before. Selling stock at a loss is essentially the tax loss harvesting, right? You look at all of your investments. If you can sell some of them at a loss, then that can offset some of the capital gains you have somewhere else. The key to this, of course, is you have to remember the wash sale rules. You cannot repurchase that stock within 30 days. Otherwise, you don't get to take advantage of the loss. And of course, the concept being if you just sold something and bought it the next day just to capture the loss, you haven't really changed your position financially or materially. So you don't get to take the loss. Now, that's not currently true for Bitcoin. Now, the IRS has not said this directly, but all indications are cryptocurrencies are not currently a security. And therefore, the wash sale rules don't apply to them. So while cryptocurrencies have, for the most part, gone up, for those of you who are investing in it, you know that. What you also know is that there are a tremendous amount of vicissitudes along the way up. And so if you caught it at a certain time, it goes down, you sell and rebuy in that moment, you should be able to take advantage of that gain. One of the things in the new Build Back Better Act, I choke every time I try to say that, try to get it out. One of the issues in the Build Back Better Act is applying wash sale rules to cryptocurrency. So this may be the last year you can do it, but it is possible. Again, talk to your tax advisor about that. And then I mentioned this earlier. The one issue about this is a lot of people playing around this by selling one kind of stock and then reinvesting in something that's very similar, something that's incredibly well correlated from a return perspective. So that if I sell one tech thing, I'm going to get another tech thing because they tend to flow together, and that way I can take the loss on the one thing I sold. It cannot be too similar, but there are lots of ways to reduce exposure in one place, but then re-increase that exposure in another where this qualifies. But that takes planning. The other thing that can be done, of course, is you can sell and in 31 days later, buy back that same position. And if you are the kind of investor who is assiduous enough to calendar those moments and get them done, great. If you aren't, let's not bother. And that's what I wanted to bring up here is don't, and I mentioned this earlier, don't let the tax tail wag the investment dog. Don't make poor investment decisions or adjust your strategy even unintentionally because we're trying to take some advantage of a tax loss here. You know, of course, that trying to time the market doesn't work very well and it can really cost you. So we don't want to be accidentally timing the market at the wrong time just because we're looking for some tax breaks. And then, of course, business owners looking to sell assets, you have the loss, again, just business loss harvesting in general. Okay, we talked a little bit, I mentioned this before, qualified accounts. So when I said maximize deductions, remember a qualified account works because when you make a contribution to it, unlike any other account, unlike just your own savings account or a securities investment that you have, when you make a contribution, you get a deduction against your income. So it reduces the taxable income. And then the growth on that is tax deferred, right? It can continue to grow, paying no capital gains tax. Even as you churn the investment, you can make new decisions, you can buy, you can sell, you're not paying any taxable gain on that. you're not paying any taxes on those sales. Of course, when you do ultimately take the money out from the qualified asset, it is at that time ordinary income tax to you. However, that will probably be for, depending on your age, that may be decades into the future. And you might be in a very high tax bracket right now. And in the future, upon retirement, you may have far less income, and therefore your effective tax rate may be much, much lower than it was at the time you got the deduction. So it can be a huge benefit for you. And for business owners that often don't think enough about this, there are solo 401ks and there are SEP IRAs that an individual, even if a solely owned business, an S corporation, or just solely owned a sole proprietorship, can take advantage of these qualified assets. You can also make contributions and get a deduction. For some business owners, if you have a significant amount of income, and if it's a reliable amount of income, you should think about a defined benefit pension plan, also sometimes known as a cash balance plan. What's happening there is you are in fact setting up a pension plan. It is defined benefit, meaning it's not that there's not a guaranteed contribution number, there's a defined benefit number. But because of the way the calculations work, that can provide you with a much larger deductible amount at the outset and over the course of years as you're funding this. It is not appropriate if you don't have reliable income. If you never know from one year to the next how much income you're going to have, or if you're going to be break even or at a loss, etc. Because you have to do some actuarial work, there's a lot of administrative costs. And if you can't continue to fund these things can actually blow up on you. So it's certainly not right for all people, but where it makes sense for you, it can provide a tremendous tax savings. Probably not an idea you could implement before the year is up, but something you should absolutely be thinking about going forward, because those rules don't look like they're going to change. There are, I should mention, some rules about qualified accounts that are proposed to change in the Build Back Better Act. I won't get into many of them here. They mostly involve making after-tax contributions to different qualified accounts and then converting them into Roths, and some things that are wonderfully beneficial for taxpayers, but probably won't be available much longer. Okay. Qualified account contributions. So other things that we can do with those considerations, the other things that we can do with some of those qualified accounts. First, we can make a Roth IRA conversion. We can do it right now. And when I was just talking about is that an after-tax contribution converted to a Roth, that's available this year as well. But in general, a conversion from an IRA to a Roth IRA, most of you probably know this, but an IRA is a qualified account, right? I get a deduction when I put money in, it grows tax deferred, and when I take it out, it will be taxable income to me. A Roth is the opposite. It's not deductible going in, but it does grow tax free, and then when I take it out, it's not taxable income to me. So I might want to convert my IRA to a Roth IRA. Well, what does that mean? Well, it means that this shift is going to be taxable income to me in that year. If I have $1 million IRA and I want to convert it to a Roth, I have $1 million of taxable income that I just created. Why would I do that? Well, because if you look at the assets that are held in my Roth, right? If you look at the after-tax dollars that are actually there, if I have $1 million, I'm in California, you could think in general, my after-tax dollars in there are $500,000, $600,000. That's what I really have once I take that out and have to pay taxes. So if instead I can convert it into a Roth with that whole $1 million, and I have the ability to pay the taxes from some other assets that I have, now my qualified account, my after-tax value of my qualified account is $1 million. I got to essentially make a contribution of $400,000, $500,000 into that qualified account by making that conversion. So you got to run the numbers on it, but it can make a lot of sense depending on what your intentions are, especially if we think ultimately this is going to benefit family and not you. If we think we're going to pass away with that, this qualified account is income in respect of the decedent. No matter what I do with it, unless I give it to charity, the recipient is going to have to pay income taxes on this. Once I get into a Roth situation, no one will pay income taxes on that as it gets distributed to my family, my heirs, etc. The other thing to think about with qualified accounts is, to the extent you qualify, is a qualified charitable distribution. This can be really impactful and is probably missed more often than it should be. The real issue is, of course, you have to be into your RMD age. You need to be 70 and a half when you're going to make this contribution. But what it allows you to do is say, all right, I'm going to take this, my qualified account, my IRA, and say, instead of taking the RMD or in lieu of the RMD, I'm going to send some of this money to charity. Now, the good news is you are going to have to take an RMD. That was going to be qualified, I'm sorry, that was going to be ordinary income to you. So if instead we push it to charity, now I don't have to take that RMD. I don't have the taxable income that I have to incur. I don't get a deduction for the payment that came from the IRA to charity, but I don't need one. I already got it, right? I got an indirect deduction because it never hit my 1040. It immediately went to charity, and now I don't have to worry about whether or not I itemize. I don't have to worry about AGI limitations or anything else. That money goes directly there, and now I will never have to pay, excuse me, income taxes on that. So it is like having a dollar for dollar deduction on those assets and can make it really, really impactful. Okay, excuse me. Okay, we talked a little bit about being charitable. At the end of the year, right, we do want deductions where we can get them. So let's talk about some ways to do that. There are some different deduction rules this year, but in general, the concepts are what they have been in the past. Right now, and what is unusual and probably won't exist next year, a cash gift can be made to qualified charities, that is public charities, not to donor advised funds or anything else, but to qualified charities. Cash can be deductible, excuse me, up to 100% of your AGI. Now that is unusual because typically the limit is 50%. I'm sure that this was put in place because during COVID, there was a concern that some of these charities aren't going to get the same funding that they were getting before. And so we want to incentivize giving. I'm not sure how many taxpayers bumped up against the 50% AGI limit, and that's why they stopped giving. They may be out there, and maybe this does have impact. I'm not aware of anyone. I haven't worked with anyone personally who's bumping up against their 100% AGI, although it certainly could happen with some of our clients who are essentially in retirement mode or now philanthropic in general, maybe have some small amount of income and are giving essentially all of that away. You can also, of course, give away appreciated stock. In fact, if you have appreciated stock and you're going to be making a charitable contribution, almost always the right idea to give the stock itself. The deduction limitations are a little bit different, but again, unless you're bumping up against your maximum, against your AGI, 30% of your AGI or more, then giving the stock gives you two deductions, right? Because if I have $1 million of stock, which only has a $100,000 basis, and I want to give $1 million to charity, well, I can sell all that. I have $900,000 of capital gain, then I give $1 million to charity, and I can get a deduction against that $900,000 plus another $100,000 I have somewhere else. Or I can give $1 million of stock in kind, just shift it to the charity. Now I got $1 million distribution and I didn't recognize any of the capital gain. So I have an extra $900,000 of deduction that I did not have when I was putting that in place, right? Because I was going to have to sell the stock to get it. So it's essentially a double deduction that you get. You have appreciated stock and you have a desire to give any kind of substantial gift. It's definitely worth your time to think about that. The other thing I wanted to mention, I talked about this a little bit earlier, is should we bunch some of those charitable deductions? That is, if you know that you're going to be giving away money over the next 5 years, if I know for sure I'm going to give $100,000 to charities over the next 5 years, I can do that. I can give $100,000 each year, and I can get a deduction each and every year for doing that. But for those of you with any kind of accounting background or just dealt with finances long enough, you realize a $100,000 deduction 5 years from today is worth less than a deduction I can get today. Now, it's true I have to set the money aside, but if I'm willing to do that, and if I was going to do that anyway, the deduction today is more advantageous. And then I can put all $500,000 into a donor advised fund. Donor advised funds are very much like private foundations, where You get to decide when and how the money goes out to charities, but you get the deduction when you put the money into the foundation, or in this case, into the donor advised fund. And it's very much like a qualified account, like an IRA. You can invest those funds in any way that you choose, but ultimately the distribution has to go out to charities. So so you are irrevocably parting with these funds. I want to be very clear about that. But if I have a big income year this year, I know I'm going to be giving away those funds in the future, and I don't have the same amount of income in the years to come. It's absolutely worth it for me to take a big deduction this year, set that money aside, invest it, and hopefully I'll have well more than $500,000 ultimately I can give to charity over time. One other feature that I don't think gets enough attention, you'll hear about it on occasion, the CRT, we love our acronyms, a charitable remainder trust. This can have real impact if you're looking at a large sale and you have some philanthropic intentions. What a charitable remainder trust allows you to do is take a big asset. So remember that client I was talking about who got the big step up from her mother? Well, let's say she didn't get the big step up. Maybe we're advising mom instead, and she's not going to be gone for a long, long time. But she doesn't want the $10 million piece of property. I think it was $5 million in my earlier example. She doesn't want the $5 million property. She doesn't want to deal with it anymore. She hates the idea of selling it now and giving 2.5 to the government and only having 2.5 left. So here's one thing we can do. She likes being charitable anyway. We can take that piece of property and put it inside of a charitable remainder trust, CRT. And then what happens? Well, that trust is a charitable entity. So it can sell the $5 million piece of property and pay nothing in capital gains. Now we have $5 million of liquidity to reinvest. And what that charitable remainder trust is going to do is pay an annuity back to us, or pay an annuity back to the client over a term of years or over the course of her life. And then whatever is remaining after that charitable remainder trust, whatever's remaining after that term or her life, will go to charity. And the advantage to this is not that you're going to get a whole lot more money than you would have if you had sold it and paid the taxes, but you'll get to change who gets most of that money, right? Instead of the IRS, it will hopefully be charity. It also, rather than having $2.5 million left over to invest, I have all $5 million to invest. I can do the things that I would be able to do with $5 million. That might qualify me for larger investments, things like that I couldn't do otherwise. And I'm going to take that annuity back over time. The annuity is taxable in the same way that those funds upon sale would have been taxable. But it's a tremendous deferral of that tax, right? Because I'm pushing out the amount of time it will take me to get that income, the annuity. And the reality is, if you sort of do the present value calculations, the after-tax number you could have gotten versus the annuity you will receive over, let's say, the course of our client's life, those two might be near equivalent in value. It's not the same. In this circumstance, I had $2.5 million to blow immediately. In this circumstance, my client's getting an annuity over time. But the value of those two can be roughly the same. And then ultimately, the charity is going to get a bunch of the money that would otherwise have gone to the IRS. And so that can accomplish a lot of our clients' goals in a way that is, again, better than just making a sale immediately and paying the government half of it. All right. So some gifting things to be thinking about as well, especially at year end. So there are a few things in tax law, of course, that just happen every year annually, and then they expire if you don't use them, maybe about HSA contributions and of course, qualified accounts. Another one, qualified contributions. Another one that exists is tax-free giving to family members. So right now, each one of our clients, each one of you who are watching, can give up to $15,000. A married couple can give $30,000 to as many individuals as they want, as many family members as they would like. And next year, in fact, that's going to be $16,000, so slight increase. If that's not used, then it's lost. We've simply lost the ability to shift some of the wealth intergenerationally in the way that we want to. Now, those gifts can be outright to beneficiaries, they can be outright to family members, or, although there's a little extra complexity to it, they can be placed into a trust for the benefit of family members. The complexity is well worth it if you would not otherwise cut a check to a family member, but would like to set money aside for family members that we can invest and do other things with, then absolutely this is one way to do that. And again, it doesn't use up any of your lifetime exemption, which I'll talk about in a second. And this can be done on an annual basis, and it can be done for each and every family member who's a permissible beneficiary of the trust that you put in place. You can invest those funds just directly into a stock account and do the kinds of long-term investing you might do with those funds that you put in place, which can be pretty tremendous over time. And you think about that over the course of 5 years, you multiply your family members by $30,000 each, $32,000 next year. Those numbers get pretty big. It can also be commonly used to pay a life insurance premium, because we've now used up no lifetime exclusion. We've purchased a policy that will ultimately provide a ton of liquidity for the family that is income tax free and estate tax free. So it's one of the most common uses of those annual exclusions is to pay a premium for a life insurance policy that's held outside the taxable estate. The other way that this is used frequently is in 529 plans. A lot of you know that a 529 plan is like a qualified plan in that, except you don't get a deduction putting money in, unfortunately. If you put money in, though, then it can grow entirely tax deferred. And if the money is spent on education expenses, qualified education expenses, you never pay capital gains on the growth of those investments. And so that can be a real advantage. And you can super fund a 529. You can use 5 times your annual exclusion at one shot to fund a 529. And on the topic of education and perhaps health, always keep in mind that there is no limitation to how much you can spend on a family member or anyone's educational expenses or healthcare expenses. The only restriction there is, unlike the 529, you have to pay the expense directly to the foundation. You have to pay the expense directly to the educational institution or the healthcare provider. You cannot cut a check to a beneficiary so that they can go pay tuition. You have to pay the tuition. Okay. Also, and this is not used very frequently, but we do have these exemptions. And if you're going to sell stock anyway, one thing to consider is maybe we simply make a gift to a family member who is in a 0 or 15% capital gains tax bracket. Let them sell the stock we were going to sell, especially if we were going to make a gift of cash to them anyway. Why not use some of the stock? That zero tax rate exists for a little while. And if you have someone who's not making a lot of money, but is an adult, no kitty tax applications, etc., then you can make a gift of stock to them and they can sell the stock at maybe a much lower capital gains rate. Something to consider towards the end of the year as well. Okay, one of the things that, again, maybe the biggest surprise to me in what is being proposed is that it looks like we're going to keep until 2026 these gigantic estate tax exemptions. Right now, they're more than $11 million. Next year, they'll be, assuming we keep them next year because of the inflation escalator, there'll be more than $12 million for each person. That's more than $24 million for married couples that you can give away during life or have at death and not pay a penny in gift or estate taxes. After that, you pay an estate tax of 40% or a gift tax of 40% if you burn all the way through those exemptions. But those exemptions they're scheduled now to expire in 2026. That is, as of 1/1/2026, they're gone. I thought for certain they would be gone 1/1/2022. So we certainly have more runway than I expected. But this is really, really important for our clients who have, as I mentioned before, real estate investments, closely held, valuable businesses. If you are intending to get that business to the next generation and you're seeing growth and you're seeing the value appreciate over time, let's get that estate tax monkey off of your back, because no publicly traded corporation, for instance, could afford to pay 40% of itself to the government every generation. It would never survive that. And a lot of closely held but valuable businesses and investment structures won't survive that either. So we need to start looking at some of the techniques that are available to us still. Remember, I thought we were going to lose a lot of those. They are still available to us as this law is drafted. We will still have the ability to protect a lot of that wealth from the estate tax without giving it to children or giving up control. There are, of course, technicalities and things that you have to deal with. I mean, these are real strategies and there are real irrevocable things that need to be put in place. But you'd be amazed at the flexibility that can be retained, especially when you look at the tax savings, which if you look at it generationally, can be a breathtaking amount of money that can be saved and ultimately could be the reason that the family is able to keep the business. And then finally, it's never fun. No one likes to think about death, but review your estate planning at the end of the year. We're already thinking about all these other topics. Let's look at the documents that are in place. Certainly, clients of ours should feel free to give us their documents. We'll take a look, talk to you about what we see, talk to you about the things that we think maybe could be improved, if there's anything that needs to be improved. Very frequently, we have these conversations with clients and we say, so long as your goals are still the same as they were then, this is great. You don't need to really do anything to this. But let's talk about that. Let's find out who those names were. Let's make sure those names that you nominated are still part of your life. And they're still the kind of people you would trust to take on the roles that they would have to have here. Look through all of that and then think about probate avoidance where it's necessary. I won't get into all of that here today, but it is a tremendous relief to the family when a vast majority, if not all, of the assets that happen upon someone's passing occur without having to go through a probate process. There's also a lot of planning to be done. Again, it's morbid, I know, but there's a lot of planning to be done upon the first death of a married couple. There's a tremendous amount because of that basis step up we talked about, and because California is a community property state, there is a tremendous amount of planning that can be done at that time. And so we don't want to make any bad moves right before. If we know ultimately, unfortunately, someone's going to pass away, we don't want to be paying a huge amount of taxes that could have been avoided otherwise. And upon someone's passing, we want to take a look at the overall financial structure, the goals that the remaining spouse has for herself, himself, and the family, and be able to take some action there. So I'll stop there.